We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome back to The Long-Term Investor. This week, I'm joined by my very good friend, Rubin Miller, and we have another Talking Shop episode, a little more casual, completely unscripted. I just actually got off the call with him now. We talked about all sorts of things. We talked about predictions and expectation setting. We talked about AI. We talked about bonds. We talked about cash. So much good stuff in this episode. What I'm finding interesting is that these unscripted episodes tend to be a lot longer. I'd really love to know what you think of the format. We're going to be returning to our normal guest format for the next several weeks, but just trying out some new things for the new year, see what people like, see what resonates. As always, you can find detailed show notes at thelongterminvestor.com, where I will link to things that we discussed, as well as share ways that you can follow my good friend Rubin. But enough of me, let's get into it. Here is my conversation with Rubin Miller. Welcome to The Long-Term Investor. Today I have my good friend Rubin Miller with me. Rubin, thanks for joining me today.
Always a pleasure.
It's not quite Christmas when we're recording, but it is January 7th at the time that this is airing. This is the second episode in a row where I'm trying to keep it casual, trying to give people a little inside look into what some money nerds talk about when things aren't recording. But here we are, we're recording. But it's also prediction season, and you have always notoriously been a loud hater of predictions. I don't think anybody who listens to this show is a big believer in forecasting the future, but love the visual that you put out on LinkedIn the other day about predictions. You've done it before, but you have the field. I'm just also seeing what you have written for your name in the recording, which is great. For those of you in the podcast, his name is I Carry Peter's Bags. Love it. Talk to me about forecasting. What grinds your gears there?
A lot. I think it's one of the standing legacy spillovers of like traditional Wall Street and people thinking that they have to put forward these forecasts, which in my opinion, for most risky assets are completely unforecastable on the timeline that experts pretend to do this. I think the second order challenge is that for financial planning focused advisors, we have to put in assumptions in financial plans. Like I have to model out how a portfolio is expected to grow so that when I add how much a client is earning and take out how much they're spending and do all that, like what are we left with? And can you live the life you want to live? So you have to do some reasonable forecasting. Even if I don't like short-term forecasts, I have to do some long-term forecasting. If you're really prudent about it, it's about describing ranges of likely outcomes for somebody's portfolio in their life. And I just think this idea that in December, if you're a bank, you go publish where you think the S&P is going to be in 1 year from now. It's not just a disservice because nobody knows, but it also hides what's actually important about jobs like ours, which is helping people get to where they want to go and live the life they want to live, where we do have to do some reasonable forecasting. And 1 year forecasting tends to like give that a bad name.
You make a good point on the capital markets assumptions. We use eMoney as our financial planning software. What do you use? Do you use eMoney or Money Guide Pro? Or
We use Right Capital.
I feel like everybody's on one of two, but shows what I know. I'm not the guy who's running the financial planning model, so I'm the wrong one to list them off.
They're all kind of similar. They all do the same thing.
They're like a good user interface of a super spreadsheet. I know at my first job, we ran our Monte Carlo simulations in a giant spreadsheet using Crystal Ball, which sort of allowed you to exceed the number of cells that is in Excel and do more model runs than you otherwise could. I am responsible for the return assumptions that do go into those models. And one of the things that's crazy to me when I talk to other people in my role is how specific people get with their assumptions and how often they change them. And to me, when you're sitting down and you're running a Monte Carlo, and for those of you watching us, whether you're watching us on Cheddar or on YouTube or you're listening to us on the podcast, if you don't know what a Monte Carlo simulation is, basically you're running 1,000 trials or 10,000 trials with randomized returns to figure out, hey, is the life I'm trying to live, is that realistic? And if not, what needs to change? And the thing is, whether you're 60 or 30, chances are you're running the model for 30 years. What does a 10-year forecast even matter? And to me, You look at long-term real returns on stocks, they're just a little under 7%. On bonds, I guess if I want to be conservative, they're about 2%. Although we do know what the next 30-year bond return is going to be. You love talking about that. But talk me through your process when you have to set the assumptions in your financial planning software. What are you thinking about?
With bonds, from a nominal perspective, it's obviously very hard. Thankfully, after inflation, bond returns are more stable and predictable over time. You tend to do a little bit better than inflation if you own short-term bonds, and hopefully a little bit better than that if you own intermediate-term bonds. But obviously, any interest rate environment, I have no idea. It could be the 70s and we have 18% interest rates, or it could be 6 years ago and the interest rates are basically nothing. The periods where you have high interest rates, obviously we have high inflation. So it's not as dissimilar after you look at the real return comparison. But for us on the stock side, it's pretty simple because I don't do anything different for almost any clients in their stock exposure compared to any other clients. So if I had a 30-year-old who works at Apple and makes 400 grand a year and gets paid a bunch of RSUs and blah, 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 and I have an 80-year-old who hasn't worked in 20 years and is widowed and blah, 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 and I say, hey, you need to own some stocks, they're going to own pretty similar stock portfolios. I don't have a reason to change that. Maybe the person works at Apple, and so I don't want to own as much Apple stock, but otherwise, the actual stocks they would own, I'm going to try to buy them a little bit of all 13,000 stocks across the whole world. The ratio they own them compared to the rest of their assets, that's what's going to be very different. An 80-year-old widow is probably not going to own that many stocks if they have traditional goals in their life. And a younger person is probably going to own a lot of stocks. And so the weight of their life, their equities will be more. But as far as the actual ones we own, I don't have much of a reason to deviate. Stocks are stocks. We all own them for the same reason. We want them to grow. Bond side is very different. If I just use those same people, somebody who makes a bunch of money, lives in California, works at Apple, high income, high tax state, all of a sudden there's different types of bonds that do different things. Municipal bonds help you pay less taxes. On an equivalent yield perspective, muni bonds sound like they might be a great option for someone that makes a lot of money in a high tax state. The 80-year-old who's not really making anything anymore, but might have a big portfolio, doesn't really have much of a reason for owning muni bonds, especially if they live in Texas or Florida where we don't pay state income tax. On the bond side, I just use munis as an example. Bonds are just so different than stocks because they're tools to accomplish a variety of different things. One of them might be lower taxes. Some people might want more predictability, short-term predictability. Somebody else might say, I want to pay for my daughter's wedding in 14 years, and I'm going to buy a treasury bill that matures in 14 years and lock that goal in right away. These are tools. Equities aren't really, they're just one tool. We're just trying to make the portfolio grow. For that reason, on the stock side, it's all similar, and I have no reason to do anything else except say, what is the long-term average of buying people's companies? That's what buying stock is. So if I go buy a little bit of every stock across the whole world for somebody, what's the long-term return of that? I don't know if conservative is the right word, but I try to use wide ranges because I don't know what it's going to do. Like, it's so noisy. We're in the last week of the year. Markets could go up or down 3% in the next week. That'd be super reasonable. And that is going to be up 50 or 100% of some people's expectations for a whole year. It's so silly to get precise, but I think long-term nominal returns for stocks, 8 to 10% average seems like a reasonable range. I think you said, the after inflation tends to be around 7. So that's reasonable to me. And there's many different types of investors. Some people forecast and they would say, well, we're going to do 13 or 15 or 2 or 3 or negative 10, whatever it is. I don't do that. I don't think that's productive because I don't think anybody knows. So the long-term average tend to be pretty reasonable to me. Where it starts to get hard is when equity valuations, so say how much these companies cost, their price, divided by how much they make, say earnings, is really high. So if stocks are really relatively expensive to historic or really low relative to historic. And when it is true that if you look at some sort of regression on when stocks are expensive compared to when they're cheap, the next 10 years tend to be a little bit better when stocks started cheap and a little bit worse when stocks started expensive. That is hard for me. How do I want to model in that, but also not pretend like I know where stocks are going to go in the next 10 years? So I don't have a problem with people that do tinker with that a little bit. Maybe since stocks are relatively expensive right now, instead of 8 to 10%, I might say 5 to 8%, 5 to 7%. I don't do that much of that. We tend to create buffer in client portfolios in other ways when we forecast out. So we don't do it in our actual measurement of the equity valuation. You can do it in many ways. One way might be, I'm really comfortable when clients have a 90% plus likely success rate in their plan.
10% of the time you have to make some change in your life to make sure you don't run out of money. It's not like you're going to let your clients run out of money. So 90% is pretty solid.
Exactly. Somebody else might say, we reduce our expected return on stocks because they're really expensive right now. And so we use 6 to 8% for the next 10 years. And I'm like, okay, well then your 90% is different than my 90%.
You know what I don't like about that either is that if the Monte Carlo is running 1,000 different scenarios, within those 1,000 scenarios, there are going to be periods where the next 10 years are bad. And that's where I feel like so many people do what you talk about. It drives me nuts. In 2 weeks, so I'm not going to totally give up the episode that I'm doing in 2 weeks after this airs, but I'm talking about like how PlanCorp sets their capital market assumptions. But you're talking similarly to how I think about it. Like you can't predict the future. And how can you make good long-term assumptions? Returns might be lower in the next 10 years. They might be higher. But the whole point is 30-year returns, especially 30-year real returns after inflation returns, are very consistently hugging the average. And when you're doing these models, you don't need to worry about what the next 10 years are going to be. That's the whole point of modeling. Something I want to talk about because there are two people who are coming on the show as well. I'm just going to talk about the future of the show the whole time that you're sitting in front of me, Rubin.
Talk about real people that come on your show.
Real people. Well, so next week is Liz Ann Saunders from Schwab. Liz Ann is probably my favorite economist, market strategist for my entire career. Been following her work for about 20 years.
How cool.
I happened to meet her in person for the first time in November and just told her how excited I was. And I felt like I was standing outside a concert, just dying to see some musician. Like I'm sure is totally fanboying. So she's on next week. And there's some things that I'll come back to that I think that people in her position have a tough job because they're not necessarily forecasting the future, but they're creating context for the environment we're within. But after that's Kevin DeCurio from Vanguard, and he sets the return outlooks for the 10 and 20 years. And that's actually why I brought this up. They were some of the first people I ever saw make projections based on a bell curve. They're not just saying, hey, here's the S&P 500 price target. For the next 10 years, I'm kind of looking at it now. Vanguard says U.S. equities, the median outcome or the median return, average return for U.S. equities is 3.8%. For bonds, it's 4.3%. For developed markets, it's 6.3%. So yeah, like they have a 10-year outlook where non-U.S. stocks win, where bonds win. If I go out to 30-year though,
bonds beat stocks, U.S. stocks.
In the median outcome, in the 50th percentile outcome, they have bonds beating stocks. Now, when you go to the 95th percentile, where equities have their highest possible return and bonds have their highest possible returns, then obviously equities beat them. But I think this is the right approach. I mean, I don't think year to year, there's a whole lot that could change about the world that would make me change my capital market assumptions. But I do find some of this stuff useful for setting expectations. So let me pivot a little with you. On the expectation setting front, you're really good about education. I think it's why you and I have so much to talk about. What are things that you're talking to clients about now? You're going to be writing a newsletter for your clients pretty soon, I assume. What are some of the things that you anticipate talking about going into the new year?
It's not forecasting that is the devil here. It's that we should speak more in ranges, and then we should add probabilities to it. The post you were talking about on LinkedIn that I published at the end of last year was basically like my response to these forecasters who do one-year forecasts, where I basically said, here are my forecasts. Of the 12 asset classes people do this for, 8 of them I'm not willing to give you one. Stocks, Bitcoin, gold. There's literally nothing to try to forecast. There's no way anyone could get close on 1 year reliably. But I could tell you a range and say, hey, with stocks, I think 90% chance, 95% chance, it'll be negative 40% to positive 30%. That's just not that helpful. But I think that's a reasonable statement. If you looked at all the data, that's probably about right. Probably that happens 90% of the time. What are you going to do with that information? What I talk at a high level with clients is going to be like, hey, I can give you these things, but we're an evidence-based, data-driven firm. We have to contextualize them. So I can give you a range of what I think will happen and then give you a probability around what think means. Maybe it's 90%, maybe it's 50%, 70%, whatever it is. But we have to give better backdrops to these comments we make because people take what we say seriously. If I just said to somebody, I think stocks will do 8 to 10% next year, that's a true statement. If you ask me, Rubin, on your deathbed, what will stocks do next year? I'd say 8 to 10%. Why? That's their long-term average. That's my best guess. Do you actually think it'll be 8 to 10%? No. Almost certainly it will not be 8 to 10%. but it'll almost certainly not be whatever I tell you because it's random. The longer time horizon we have, obviously, the less random things become. There's a reason we earn a return for buying parts of other people's companies. We're putting our capital at risk, and humans tend to be pretty productive and creative and resilient, and they create good businesses that make money. It makes sense that over time, these equity positions we have in stocks, they do better than treasury bills. They do better than bonds over time. We expect them to. I think that when I do set expectations with clients, sometimes it's got to be quantitative, ranges, probabilities of success around that range, what I expect. If I actually think it'll happen, as I said, I can give you the range, but I might have no confidence that it'll be right, but it's my best guess. The article you're talking about that I posted, the reason why it's like a thing for me was it got picked up in the journal, it became a thing for our firm, and it was basically like this anti-forecast forecast. But the thing that so many people miss about forecasting is that while it's unreasonable for someone to tell you, I think stocks will do 10% next year, and not tell you like, by the way, I'm not that confident in it, that's just my best guess. I could do that. But if someone says like, I really think stocks will be 10% next year, that's crazy. No data would allow any human to say that seriously. We all know how random stocks are over a 1-year period. However, not all asset classes are like that. So there's a spectrum of things that are super random over short periods, like stocks or Bitcoin or gold, and things that are not so unpredictable over short periods or not so random over short periods. The classic one, which was on the visual you're talking about, is the 1-year treasury. A 1-year treasury is a loan with the government. You loan your money to them. They promise you a return, and you can literally on a 1-year timeline to the nth decimal, get your actual return. So while I'm not willing to give an expectation on stocks, like I have an NA, on the 1-year treasury, it's like to the third decimal because like I know what I'm going to get. I don't think everyday investors think that way. If I said to somebody like, isn't forecasting crazy? They'd be like, yeah, it's crazy. They don't really know what that means. Like forecasting stocks is crazy. But on the spectrum of risk, there's some things like short-term bonds, ultra short-term bonds that are not so crazy and can make a lot of sense and honestly be very helpful when people have liabilities. Like I was talking about the pay for your kid's wedding in 17 years, pay for your kid's wedding in 1 year. You can set these liabilities and use non-risky assets and have a lot of clarity around how to get there. I think what we can do is a better job on education. Our firm's fairly traditional. We don't use a lot of cheeky products. What we think is best for clients tends to fit in a fairly tight sandbox. So we can talk about returns, expectations, how randomness might impact the outcome of this asset over 1 year in a fairly narrow way so we can get it done in our annual planning meeting or whatever. But I think it's our job is to set expectations around the different types of things people own and what to expect from them over whatever timeline we're talking about.
The expectations part to me is so important. So much of our job is just creating a good investing experience, maybe even more so than picking the investments. As we wrap up 2025, it's easy to forget we had a bear market this year. There are times where I've sat in on client meetings, they're looking and they're confused why, as they look at a chart of the year and the portfolio value, like, why is there this dip in April? It's like, we lost about 20%. We being like the S&P 500 lost about 20%. You forget that.
Glencore clients lost like 35%.
I don't feel like compliance is going to like that statement. So this will be a test to figure out how closely they're watching. No, market-like returns. But I feel like in general, you're going through this process with people and they want to make sure that there's nothing being missed and they want there to be certainty. And I don't know if you've ever heard this line. I'm somehow coming up on 20 years in this career path. The consistent line I hear is, I'm not a market timer. I know we can't time the market, but ...
We work for about 70 families, and I think I'm good for 6 to 7 of those a year.
I think the themes that we get on it, they're always political. So it doesn't matter what your political views are. It's basically like if who is in office is on the opposite end of who you voted for, you fall into this, I'm not a market timer, but, or I know we can't time the market, but what about this? I feel like AI is a big one. People don't understand it. And if they don't understand it, they get scared of it. I'm not saying there isn't a bubble there or there is a bubble, but generally speaking, one of the things that we go through in the planning process, and I think you do too, is, okay, so we're talking about returns. We know that the market's going to fall with a similar magnitude and frequency as it has in the past. And you get people comfortable with the idea that, yeah, you're going to lose 20, 30, 40% at some point, depending on your mix of assets. If you have a conservative portfolio, maybe you're not losing 40%, but I don't think people get worried about the actual volatility. They're scared of the narrative. And we can't prepare everybody for whatever narrative is going to exist 10 months from now or 10 years from now. And so to me, that's so much of the challenge is how do we keep expectations in line and try to make sure that expectations and reality are tight? Because the worst thing that any investor can do is change the plan, is react. Our job here is to create an environment where they don't react, where they stay the course.
We had a bear market. We also had one day where the S&P was up 10%. Why don't we ever talk about that anymore? That was crazy. One day, and it was up 10%. Now, obviously, there was a bunch of bad days that then led to that. That tends to be how market volatility comes. A lot of up days, a lot of down days.
But if you jumped out of the market, you missed it.
These big events happen in such concentrated periods, and then we recover and people move on with their life. And now people are jittery again about a down 1% day or whatever it might be. Do you remember 8 months ago when we went up 10% in one day? Those are the moments and periods that change an investor's trajectory over the long term forever, not these placid period that we're in right now where it's kind of fluttering. Right now, we want a plan that we're just executing, and there doesn't need to be that much communication with clients about the investments today. In the future, when we have something like April again, we still want to do the exact same thing. Our job is to have clients keep just implementing the pre-designed plan, but we just need so much more communication around it to get people to go along with us at that time. It's easy right now. It's a lot harder when we're going through those things. I find that on the political narrative or being uncomfortable with like AI or something, there's another bias where an investor has an opinion. Let's say AI sucks or Trump sucks, whatever your opinion is. Then it's realized in the market. AI stocks get hit or the market broadly starts to go down. Now they're like, hey, market's going down. We should get out. The market's never going down. The market went down. Now I have no idea what it's going to do after this. It might go up 10% in one day. People latch on to, I have this opinion. I've now seen inklings of my opinion manifested in the market moves. And now I'm right. And now it's time to get out or get in or whatever it might be.
I saw that happen for sure when the tariffs were announced. The election results came in. There was a lot of talk of tariffs. You have inauguration and there's more talk of tariffs and people are like, it's going to happen. It's going to be bad. And then the tariffs came and it was bad. And they're like, see, that literally played out this year. And it sort of ignores the infinite futures that could have happened. And I love it. I've actually never thought of it that way. I love the way that you just said it, where it's, no, they went down. They're not going down. They went down. Now let's look forward. Yes, they could go down more, but you go back to like, what is the most likely outcome? What's the base rate? What tends to happen over the long term? More often than not, the markets do go up. And when you are investing, it's not like you need all your money next year. And if you do, then you're investing incorrectly, I think. But if we only got a newspaper once every 10 years, think of all the great progress we'd have. You're just betting against the human spirit whenever you're selling your stocks, in my opinion.
The access to financial market data, this constant influx people have on their phone or on TV, it drives you a little frenetic, like it's chaotic. But the other thing it does is you're almost always going to be reinforced that you had some thought in your mind that you could have done that would have worked. Because markets go like this. This is what risky assets do. They don't usually go like that.
For those on the podcast, he's doing the Macarena.
I'm doing the Macarena. They zig and they zag. They might directionally go up over time, but they're very forgiving typically over short and sometimes even medium periods. Even something like a diversified stock portfolio, it tends to not go straight up. If you're always looking at the information about markets and you have opinions and you kind of want to act on them, but maybe you hire someone like us who's trying to keep you in your seat all the time, at some point, you're going to be right. You would have been better not listening to stupid Rubin, selling all your stocks and buying them back 2 weeks later. You're probably going to be right at some point. So that's one of those things where it's probability wise, you are probably correct that that will work out at some point in the next year to have sold your stocks on that day. However, the magnitude of being wrong, of being out of the market on March 9th, 2009, where we never looked back, if that was the day you did it, you ruined your whole life. Your whole life. People don't think about the magnitude of outcomes. They just think about the probability. And I think we are exposed to periods where investors want to buy something. I want to buy this crypto thing. I want to buy the stock. And their advisor might be like, we don't really do it that way. We're diversified, low cost, blah, blah, blah. And the reality is at some point in the next 6 months, it'll probably worked out better what they said. But the small probability that they time it wrong or do it wrong can blow the whole thing up. One of the beautiful things I think about firms like ours that are systematic in the way we manage money is we focus so much on not blowing the whole thing up. And we don't take 95% chances that we'll be right if the 5% is just awful for our clients. And so we think that way, second order wise, not just about probabilities, but about magnitude of being wrong.
Yeah, I love that. I mean, we're not investing here to earn the highest returns. I mean, that would be awesome. But the whole reason you work hard and you have these savings, and if you could put your savings into cash and have that just work out, have it grow fast enough in cash, that'd be great, but you can't. So you invest to grow your money faster than the rate of inflation, and hopefully a lot more. And when you own stocks, that gives you the greatest chance of outpacing inflation. When you own bonds, boy, I get a lot of questions on bonds these days. It also outpaces inflation, but at a smaller rate. So in some ways, you're just changing the risk you're taking. Let me ask you this about bond, though. Hard pivot on bonds. I don't think I've ever asked you this before. So 2022 was obviously a terrible year for bonds, worst ever for US bonds. The ag was down double-digit percentage points for the first time ever on a calendar basis. One of the things I've noticed is that when people are looking at a fund or a bond allocations like 3 or 5 year returns, it's still capturing that 2022 period. Right now, even though interest rates are falling, money market funds are still earning attractive yields where people are saying, why wouldn't I earn this certain yield in cash when bonds have only done this over the last 3 years? First of all, I know the answer, but I want to hear you give it. But two, like, are you experiencing that? And how fun will it be when the 5 year period and 3 year period, 2022 drops out of it, and you're going to see incredible bond returns, incredible relative to the first 15 years of my career when interest rates were zero.
I had the luxury of not really having to deal with that. I lost my firm in 2023.
Oh my God, I forgot that. Oh man.
I was CIO at a much larger firm where I made bond allocations.
Lucky you. It's sort of like starting a firm in 2025 when international has been beating US this year, whereas for the prior almost 20 years, US has been beating international. So that question doesn't apply to you, but let me ask you this. You have a lot of opinions on fixed income.
And religion and politics.
We in the group chat like to make fun of you a little bit. You love the risk-free rate, all these things. Give me some high-level thoughts on fixed income. What are you thinking about? What are you excited about? I'm going to ask you about cash too in a second, but let's start with bonds.
I was a bond trader. My first part of my career, all my 20s, I was slinging futures and options in Chicago. Bonds have been a bigger part of my world than any other part of this industry. From a traditional portfolio design perspective, my firm tends to work with people in their like 40s, 50s, and 60s. We have some retirees too, but we generally work with younger folks. Almost everyone that comes in, I recommend more bonds to them than they currently have. So philosophically, I think that people should focus more on the experience of the investment journey than maximizing returns on expectation. If I stick you in a 95% equity portfolio compared to an 80% equity portfolio, and you're going to close your eyes for 30 years, there's a very, very high probability you're going to be better owning more stocks than bonds. But we don't close our eyes for 30 years. And one of our jobs as asset allocators and people who are holding clients through this journey, partnering on this journey together, is to make sure that you stay on this journey. The worst thing to do is change the plan when markets get chaotic. I almost always find that people come in with very high torque equity portfolios. They have a lot of exposure and it's worked out really well the last 15 years, especially if it's in US, especially if it's in US tech, which a lot of our clients are. And they come in and I'm like, you got to own more international stocks, less tech and more bonds. What the hell? Why would that work the last 15 years? It's like, well, it wouldn't have. But philosophically, I think I can build you a much better journey together if you don't think that what happened before necessarily has to happen next. Level one is I tend to own more bonds than I think people walk in with. What types of bonds? That's oftentimes a tax thing like we talked about a little earlier. I will say our firm, we take basically no opinion on whether US bonds or international bonds are better. We tend to basically try to split it down the middle. We'll talk about cash in a second, but bonds give us a yield. Stocks don't give us a yield. So bonds give us a yield. They say right now, a core bond domestically, Vanguard Total Bond Fund or something like that probably yields in the mid to high 4% right now. And an international one's yielding a little bit more. International bond fund is probably low 5s. There's some additional tax friction and whatever, but they're different. They're not exactly the same. And I would say you get a benefit from getting a different return stream by owning debt from other companies. I like diversification, but I don't know which one's better. And there are some challenges with bonds, which is that in the US, if you buy the S&P 500, the stock index, and NVIDIA does really well, and you go buy the S&P 500 again, you're going to buy more of NVIDIA because it's a bigger part of the market now. It gets a bigger part of the sandbox. In bonds, it's some countries doing terribly, and they're like, gosh, we got to issue more debt to try to get out of this. Now they're a bigger part of the bond market. You're going to just keep buying that country up. So you don't really want to cap weight yourself in the bond market, because when countries issue new debt, it's not always a good thing. They don't always deserve that. And obviously it's going to be riskier.
I feel like I've been hitting so hard on this point that bond indexing is nonsense. You're saying cap weighting. And so just for anyone who doesn't understand, going out and buying an index fund in bonds is not the same as buying an index fund in stocks. And you and I have slightly different views, I think, on this, not across the board. I'm just like, no individual bonds, none. If you were buying a bond to align with a specific liability in the future, that's a totally different thing. But in a long-term growth portfolio, no, like I'm just out.
We don't own individual bonds.
Okay, I thought maybe on the cash management side, you did some occasionally from places, but well, that's what I was going to ask you about cash. So shows what I know. Okay, so we're both on the same team bond fund. And index funds and bonds just don't make sense. We don't really use a lot of index funds on the stock side. We do use them, but it's not like an all index portfolio. And I love index funds. If you want to index your stock portfolio, I'm not going to push you away from that. That is just a great decision. I think you can do better, but it's a great, great, great portfolio. On the bond side, it's not what you want. And you really don't want individual bonds to. Okay.
I think it's called preferred habitat theory in bonds. There's this idea, what we've been talking about, which is that certain investors want certain types of bonds. That might be munis versus traditional bonds. It might be 3-year bonds instead of 12-year bonds. But if all of a sudden I'm going to pay for my daughter's wedding in 17 years, so I go buy a 17-year bond, and a bunch of us try to do that, it's going to push the price of that bond up, but not impact 15-year bonds or 12-year bonds or 2-year bonds. And that makes sense because I need to match my liability or whatever it might be. That doesn't really work in the stock market. We're all there for the same reason. In bonds, you need to identify, what am I trying to accomplish with this portfolio? Less taxes, matching a liability I have in the future, preservation, whatever it might be. And then figure out, after you have that opportunity set, how do I want to get the scalpel out and cut this thing up of what I need in my portfolio? Investors make this too hard on themselves. They're used to individual bonds. If you go to what I would call cut rate brokerages, there's these businesses that sell bonds and sell you ladder bond. They do all this stuff. They charge you high fees. You really just need very simple bond funds, and you will have a great investment experience. You can keep it low cost and simple, and it makes a lot of sense. And because you can use these tools, you can set the duration you want, the credit profile you want. It's very easy to use these very simple tools, put it together and be done. I find investors just make it too hard on themselves. We have people hire us and they come in and they have 120 individual bond positions. You were sold that. You don't even know what you have.
You have a bond fund. It's just really undiversified and it's very ineffective cost-wise. Portfolio of 100 bonds is a bond fund. Talk to me about cash.
We use short-term bond funds for cash. So if you look at the way kind of a duration of a quality bond fund works, investors, as the shorter duration you have, which is very similar in the quality bond fund world to like the average maturity of a bond. So I'll just use them kind of interchangeably for a second. If it's 2 years or 3 years, we would call that a short-term bond fund. It means the average time the bonds in that fund are going to mature is 2 or 3 years. That's pretty quick, pretty resilient. Bonds can go down for a little bit if interest rates go up, but then they're going to mature pretty quickly and you get your principal back and the price zooms back up, assuming no defaults, which is what we're in the quality world. However, in 2022, the period you're talking about that I'm immune from because I didn't have a firm yet.
But that you were still coaching clients through, just a different firm.
The 2 and 3 year bond funds got whacked. I know some quality bond funds that I like that were down like 8%. That's not wrong. That's not their problem. They didn't do anything that was an error. It's just if inflation pops and interest rates go up and prices of bonds go down, duration is a sensitivity of how much it's going to go down. And even short-term bond funds can go down quite a bit in an environment like 2022. Very anomalous environment. I wouldn't be surprised if I never saw that again in my life, but it can happen. And it happened. Ultra short-term bond funds is what we use for cash. I'm not talking 2 to 3 year average maturities. I'm talking 20-day average maturity. We're basically in a high yield savings account on steroids. For me, I think about business models a lot. Why don't I love high yield savings accounts? Because I'm like, why the hell are you getting a bank involved in getting your yield? This is your yield. If you want to add some intermediaries, you better expect to get a lower yield than you might be able to deserve elsewhere. Banks, unlike a firm like mine, have the ability to cross-sell products. You might be able to up your yield, but all of a sudden you got to get a mortgage through them and you got to keep $100,000 in an account with them, whatever it is. To me, the world has to work. These businesses have to make sense to us. And nobody's going to be able to operate at a loss across all their business lines. So yes, you might be able to find a better yield in a high yield savings account than what I would like to get you, like through my firm, but not forever, or you're paying for it some other way. For us, we say a client has hired us. So you're already in, you're already paying the fee. And so what's the best thing we can possibly do? I would say nip out as many third parties as we can who want their fee and go for it. And so for us, for client cash management, we have two parts. One is our bread and butter business, which is working with families. We also work for a couple institutions, but for the families, it tends to be not risk-free. So we own corporate bonds and treasury bonds, but they all are just maturing on an average, like I said, of maybe 20 days. So it's real quick turnaround in quality bonds. Imagine you buy a Coca-Cola bond. You're not worried Coca-Cola is going to default on their debt in 19 days. So we have a lot of clarity that we will get what we expect to get. And the environment from 2022, what 2022 did, and the run over, the spillage after that has been that rates on the short end popped up to above 5%. And now we're probably at 3.5% to 4%. And that's cool because they used to be 0%. You might as well go get something. It's been a great tool to help clients because so many people sit on too much cash in their bank and they're getting 0% at Chase or Bank of America.
The thing that I keep harping on this show and any other show I go on, whether it's the ultra short bonds or the short-term bond funds, they point to 2022 and they're like, look, those lost money. And one of the things, even in the moment, I remember telling people, so we assume that a short-term bond fund has a duration of 2. The back of the envelope math would tell you that a 1% increase in interest rates means that your bond fund's going to go down by 2%. That's back of the envelope. The other thing that duration tells you is the number of years where any interest rate change doesn't make a difference. It's a break even. So if your duration is 2 years and you hold the fund for 2 years, whether interest rates went up 1% or down 1%, same return. If it went up 1% and your holding period's longer than the duration, you're actually going to come out ahead. I got to be honest, Rubin, I still can't seem to communicate this in a way that resonates with people who still would prefer to either own individual bonds or, to your point, would rather hold cash for a bucket of money that is not realistically going to be used in the next 12 months, that doesn't need that certainty or liquidity. So many people these days, they're just so hung up on the advisor fee. And part of that's because you got all these unregulated people talking about why you shouldn't pay an advisor or anything. You should pay a flat fee. But oh, by the way, just make sure to listen to what I say and follow me. The bond part of the portfolio, the cash part of the portfolio, I'm starting to realize we're sort of aw shucks about it. It's almost a commodity. And I just feel like we add a lot of value there. But on the bond side, almost every individual investor I ever look at, we immediately add value because they either don't understand, or even if they start to buy in and believe intellectually, they don't behaviorally do the right thing in that piece with the cash, with the bonds. I get that they're a little different. It's not as intuitive, I guess, for people like stocks, but it's starting to grind my gears a little, getting a little hot over it.
Going back to where we started, I agree with you. And when I show somebody what I would have done in bonds, I always have to be careful when an asset allocator is like, this is what I would have done.
You're an honest guy.
But it's not true. Like, you and I don't operate that way. I literally will tell somebody, like, you own all Microsoft stock for the last 15 years, and you are now worth $10 million. I would have put you in this diversified portfolio and you'd be worth $4 million. And I'd do it again because I don't think you had no knowledge that this would work like it did. And I don't know how the next 10 years will look like. I'm very confident when I show people, like, this is what I would have done. Thank God you never met me. On the investment side, we're good planners in my firm, but you can have really good outcomes by making subpar decisions in investing and have really bad outcomes like 2022 when you might have done everything right. The bond side, when somebody comes to me with a bond portfolio, I agree with you. Not only will I show them, like, this is what I would have done, but also what I would have done almost always works out better because bonds have a lot of reliability. I can make decisions now and have a decent idea of what the outcome will be in 3 years. That's not the case with stocks where somebody can just buy a bunch of Microsoft or Tesla or options on Nvidia and beat the hell out of me. It's not reliable. You don't know if you can do it again. You don't even be able to do it once. But the data set is so small and the variability of outcomes so different between what I might do and what somebody slinging options on NVIDIA might do, that of course, from this data set, you might be right. I don't care. But yeah, sure.
Well, look, we are up against our time on the hour here. The whole format here, this was very unscripted with Rubin and Peter. If you are listening or watching, leave some comments, leave some reviews. Do you like the format? Do you like it when I'm more of a robot and follow one line of questioning? Rubin's a smart guy. He can go anywhere on any line of questioning. But if you want to follow Rubin more, Rubin, tell the people where they can find you.
I have a blog called Fortunes and Frictions. And then you can find me on LinkedIn mostly for social media.
I used to joke, even though it was true, that I thought Rubin had the best new blog on the internet, but it's been around for a while. Rubin is definitely the best follow on LinkedIn. You have to have a sense of humor. You can't follow him if you're not willing to laugh a little bit, but definitely the most informative, most entertaining follow. Rubin, thanks for hanging out with me on the pod. I am sure I'll be texting you sometime later today about other nonsense.
Sounds good. Thanks for having me.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.